Have you ever wondered how some people make money while they sleep? Imagine this. You go to bed tonight, and tomorrow morning, your money has already been working for you, growing quietly in the background. Sounds like a dream, right? Well, this is exactly what investing does. And today, I'm going to show you step by step exactly how to start investing, even if you've never bought a single stock in your life. By the end of this video, you'll know all the major types of investments, how they work, and how to choose what's right for you. And trust me, some of the tips I'll share are things even many experienced investors often overlook. So stick around because missing even one of these could cost you hundreds or even thousands of dollars down the line. Before we dive in, I want you to ask yourself this. If you could start with just $100 today, would you rather spend it or make it grow? Take a moment and type your answer in the comments. I want to see your thoughts. Let's start from the beginning. Investing isn't just for the wealthy or finance experts. It's for anyone who wants to make their money grow over time. The first step is understanding why investing matters. When you save money in a bank account, your money might grow a little, but inflation slowly eats away at it. That means the money you save today will buy less in the future. Investing is how you fight inflation and make your money grow faster. But before you even pick your first investment, there's something more important than anything else: your mindset and your goals. Ask yourself, why are you investing? Is it for retirement, a new house, financial freedom, or just growing wealth over time? Your goals will guide which investments are best for you. Here's a question for you. What's your number one financial goal this year? Type it in the comments. I'd love to see your answers. Next, we need to talk about risk. Many beginners think risk is bad, but risk is just the chance your investment might go up or down in value. High-risk investments can give high returns but can also lose money quickly. Low-risk investments grow slower but are safer. The trick is to balance risk based on your goals and comfort level. Now let's talk about the different types of investments, explained simply. First up, stocks. Stocks are pieces of a company. When you buy a stock, you own a small part of that company. Stocks can grow a lot if the company does well, but they can also drop if the company struggles. Think of it like a roller coaster. You'll have ups and downs, but over time, you could reach great heights. For beginners, it's smart to start with companies you know and understand. So here's a thought. What's a company you love and trust? Drop your answer in the comments. I'm really curious. Next, bonds. Bonds are loans you give to companies or the government. In return, they pay you interest. Bonds are usually safer than stocks, but they grow your money more slowly. Think of bonds like a steady, reliable friend who pays you regularly. If you're worried about losing money, bonds are your safety net. Then there are mutual funds and ETFs. These are collections of stocks and bonds bundled together. Instead of buying one stock, you can invest in a fund that owns many different investments. This spreads out risk, which is great for beginners. ETFs are usually cheaper and easier to buy, while mutual funds sometimes have higher fees. Imagine going to a candy store and buying a mixed box instead of just one candy. You get variety, and your risk is lower. Now, real estate. You don't need to buy a huge mansion to invest in real estate. You can invest in rental properties or real estate investment trusts, REITs, which let you invest in property without owning it directly. Real estate can give rental income and long-term appreciation. Quick question. If you could invest in any property in the world, where would it be? Comment your dream property. I'd love to see your answers. Then we have commodities, like gold, silver, and oil. These are physical things people invest in. They often act as a hedge against inflation. Gold is like a treasure chest. It tends to hold its value even when other investments fall. Of course, we can't forget cryptocurrency. Digital currencies like Bitcoin and Ethereum are extremely volatile. They can rise or fall dramatically in a short time. Some people make huge profits, some lose big. Only invest money you can afford to lose. Think of crypto as a high adrenaline roller coaster, thrilling, exciting, but risky. Now that you know the types of assets, let's talk about how to start step by step. Step 1. Set a budget for investing. Only use money you don't need for living expenses or emergencies. A good rule is to have 3 to 6 months of expenses saved before you start investing. Step 2. Open an investment account. This could be a brokerage account, a retirement account, or an app. Make sure it's regulated and trustworthy. Step 3. Pick investments based on your goals and risk tolerance. Stocks for growth, bonds for safety, real estate for income, crypto for excitement. Spread your risk. Don't put all your eggs in one basket. Step 4. Start small and stay consistent. You don't need a fortune to begin. Even $50 a week can grow surprisingly over time thanks to compounding. Compounding is when your money earns money, and that new money earns more money. Think of it like planting a tiny seed and watching it grow into a tree. Step 5. Diversify. Spread investments across assets. If one fails, others can still grow. Imagine a sports team. You don't want all players in one position. Step 6. Monitor, but don't obsess. Check your investments occasionally, but don't panic every time the market dips. Investing is a marathon, not a sprint. Step 7. Keep learning. Read books, watch videos, follow finance blogs, and learn from experts. The more you understand, the smarter your decisions. Now pause for a moment. Think. Which investment excites you the most, and why? Stocks, bonds, real estate, crypto, or something else? Drop your answer in the comments. I want to see your thoughts. And if you're finding this video helpful so far, hit that like button, subscribe, and share this video for more beginner-friendly investing content. It really helps me create more guides just like this. Here's a secret most beginners don't realize. The most successful investors aren't the ones who know the most. They're the ones who start. They start small, stay consistent, and learn as they go. You don't need to be perfect. You just need to take the first step. And here's a thought-provoking question for you. If you could go back 10 years and invest $100, where would you put it? And if you start today, what would you invest in? Drop your answer in the comments. I'm curious what you choose. Now, before we move on to the advanced strategies that can supercharge your investing journey, I want to leave you with this cliffhanger. What if I told you there are some simple tricks that can make your money grow faster with almost no extra risk? And many beginner investors don't even know about them? Stay with me, because in the next segment, we're going to dive into how to combine all these assets into a strategy that actually works, including insider tips for beginners that can save you time and money. You won't want to miss it. Now let's talk about how to combine all these assets into a strategy that actually works for you. This is where many beginners get confused. They know about stocks, bonds, real estate, and crypto, but they don't know how to put it all together. I'm going to break it down so it's super simple. The first principle is allocation. Allocation means deciding how much of your money goes into each type of investment. Think of it like making a balanced meal. You want some protein, some carbs, some vegetables, and maybe a little dessert. In investing terms, stocks are growth, bonds are stability, real estate is income, and crypto is a high-risk side option. A common beginner-friendly allocation might be 50% stocks, 30% bonds, 15% real estate, and 5% crypto. But this depends on your goals and risk tolerance. Next is rebalancing. Over time, some investments grow faster than others. If stocks suddenly skyrocket, they could take up a bigger portion of your portfolio than you intended. Rebalancing means adjusting your investments back to your target allocation. It's like keeping your boat balanced. You don't want to tip over in one direction. Now let's talk about dollar cost averaging. This is a simple but powerful strategy where you invest a fixed amount of money regularly, like $50 every week or $200 every month. This strategy smooths out the ups and downs of the market because sometimes you buy when prices are high, sometimes when they're low. Over time, your average purchase price becomes more balanced. Imagine filling a jar with water slowly. You're less likely to spill and you'll steadily fill it to the top. Here's a question to think about. If you could invest $100 a week for the next year, which asset would you focus on first, and why? Type your answer in the comments. I want to see your strategy. Another key tip is to keep emotions out of investing. It's easy to panic when the market dips or get greedy when it rises. But successful investors make decisions based on logic, research, and a plan, not on feelings. Think of investing like driving a car. You follow the rules, adjust when needed, but you don't slam the brakes just because it rains. Now, let's touch on tax efficiency. Some accounts and investments are taxed differently. For example, retirement accounts like IRAs or 401ks in the U.S. grow your money tax-free or tax-deferred. Stocks held for over a year are usually taxed at a lower rate than stocks you sell quickly. Even simple knowledge about taxes can save you thousands over time. Here's something most beginners miss: the power of compounding over decades. If you start investing $100 a month at age 25, with an average return of 7% per year, by age 60, that small investment could grow to over $200,000. If you wait until 35, it drops to about $100,000. The earlier you start, the more time compounding has to work its magic. That's why starting now, even with small amounts, is more important than waiting for the perfect moment. Now, let's discuss common beginner mistakes so you can avoid them. Trying to time the market. Many beginners buy high when the market is booming and sell low when it dips. The key is consistency, not perfect timing. Ignoring diversification. Putting all your money into one stock or asset is risky. Spread your investments to reduce risk. Following trends blindly. Just because everyone is talking about a hot stock or crypto doesn't mean it's right for you. Always do your research. Neglecting an emergency fund. Invest money you can afford to leave alone. If you don't have savings for emergencies, you may be forced to sell investments at the worst time. Now, I have a question for you. Which of these beginner mistakes do you think is the easiest to avoid, and which one do you struggle with most? Comment your answer. I love reading your insights and sharing tips that help others. Next, let's make investing even more actionable with a sample beginner plan. Step 1. Set aside 3 to 6 months of living expenses as an emergency fund. Step 2. Decide your goal. Is it retirement, buying a home, or building wealth? Step 3. Open a brokerage or investing account. Step 4. Pick your first investments. For example, start with a low-cost ETF that tracks the market and maybe 10 to 20% in bonds. Step 5. Invest consistently with dollar-cost averaging. Set a schedule, weekly, bi-weekly, or monthly. Step 6. Review your portfolio every 6 to 12 months and rebalance if necessary. Step 7. Continue learning. Follow financial news, read books, and learn from experts. Knowledge compounds like money. Here's a question for you. If you could only pick one investment to start with today, what would it be? Stocks, bonds, real estate, or crypto? Drop your answer in the comments. I want to see your choice and why. Remember, the most important part is starting. Don't wait for perfect knowledge or perfect timing. Every expert investor started somewhere, often making mistakes, learning, and improving along the way. If you found this guide helpful so far, please like the video, subscribe for more beginner-friendly investing content, and share this video with a friend who wants to start their investing journey. It helps me create more detailed guides that can actually help you grow your wealth. Before we wrap up, I want to leave you with one final thought. Investing is a journey, not a sprint. Small, consistent steps over time can turn into massive results. Imagine checking your account a year from now and seeing that your small, disciplined investments have already started growing. That feeling is better than any quick money scheme or get-rich-fast trick. Now here's something exciting. The strategies we talked about so far are the foundation. But there are also advanced tips for beginners that can accelerate your growth without adding significant risk. For example, using tax-advantaged accounts, reinvesting dividends, and using simple index funds to capture broad market growth. Many beginners overlook these and miss out on huge opportunities. And here's a question for you. If you could pick one advanced investing tip to learn more about, would it be tax strategies, dividends, or index funds? Type your answer in the comments. I'm curious what interests you most. So, to summarize what we've covered, you now know why investing matters, the main types of assets, how to allocate and balance risk, strategies like dollar-cost averaging and rebalancing, common beginner mistakes, and a simple step-by-step plan to start today. The most important thing to remember is this: start now, stay consistent, and learn as you go. Even small investments today can grow into life-changing wealth over the years. Your future self will thank you for starting now. And finally, think about this. If you started investing $50 a week today and kept it up for 20 years, what would your life look like then? Take a moment to imagine it, and drop your thoughts in the comments. I'd love to hear your vision. Thanks for watching. And remember, the journey to financial freedom begins with a single step. Start small, stay consistent, and let your money work for you.